Saving money will not protect you from a broken system. In 2008, millions of people did everything right. They had jobs, they had homes, they paid their bills. But the system underneath them collapsed anyway. And if you don't understand why that happened, in simple terms, you might be building your financial life on the same fragile foundation. So today, I'm going to explain the 2008 financial crisis like you're 10 years old. You don't need a PhD to understand, just a simple story about houses, promises, and human psychology. Because once you see it clearly, you'll understand something bigger. The crisis wasn't just about money. It was about incentives, it was about leverage, and it was about what happens when everyone believes prices only go up. Let's start with the safe advice. For decades, the American dream looked like this. Go to school, then get a stable job, then you buy a house, pay it off over 30 years, and retire comfortably. A house wasn't just a place to live. It was your biggest investment, your security blanket, your proof that you made it. Banks reinforced this idea, the government reinforced it, and your parents reinforced it. And for a while, it worked. House prices kept rising, people built equity, everyone felt richer. But here's the problem nobody talked about. What if home prices didn't always go up? And what if the entire financial system was quietly built on the assumption that they would? That's where the real story begins. Imagine you own a lemonade stand. You sell lemonade for $1. Your friend says, hey, I'll buy your stand for $10. Next week, someone offers $20, then $30. Now everyone believes lemonade stands are amazing investments. So more people build stands. But here's the twist. Some of them don't even know how to make lemonade. Some don't have lemons. Some don't even have customers, but it doesn't matter because they're not buying lemonade stands to make money selling lemonade. They're buying them to sell them to someone else for more. That was the housing market before 2008. Banks started giving home loans called mortgages to almost anyone. Good credit? Sure. Bad credit? Also sure. No income verification? Why not? Because housing prices were rising so fast that it seemed safe. If someone couldn't pay their mortgage, the bank could just sell the house for more money. But here's where things get interesting. Banks didn't just give loans, they bundled thousands of mortgages together and sold them as investments to other banks and investors. Think of it like this. They took a pile of IOUs, wrapped them in a fancy box, slapped a safe investment sticker on it, and sold it around the world. Therefore, risk wasn't disappearing. It was spreading, and nobody really checked what was inside the box. Let's simplify it. Step 1, banks give out risky home loans. Step 2, they package those loans into mortgage-backed securities. Step 3, investors buy them because they're rated safe. Step 4, everyone makes money as long as homeowners keep paying. But here's the fragile part. Many of those homeowners couldn't actually afford the homes. They had adjustable rate mortgages. That means their monthly payment started low, but later would jump much higher. And when those payments jumped, millions of people couldn't pay. Therefore, defaults started rising when homeowners stopped paying. The safe mortgage investments weren't safe anymore. They were full of unpaid loans, and because banks had borrowed massive amounts of money, leverage, to buy those investments, even a small drop in value became catastrophic. This is the key. If you invest $10 of your own money and lose 10%, you lose $1. But if you borrow $90 and invest $100 total and lose 10%, you lost your entire $10. That's leverage. In 2008, the entire financial system was highly leveraged. Therefore, when housing prices fell slightly, the losses multiplied. Banks stopped trusting each other, credit froze, businesses couldn't borrow, people lost jobs, and suddenly it wasn't just a housing problem, it was a global financial crisis. And here's the part that matters to you. This wasn't caused on purpose, it was caused by incentives. Loan officers were paid for approving loans, not for long-term performance. Rating agencies were paid by the companies creating the investment products. Investors chased higher returns because everyone else was. Home buyers believed prices would keep rising because they always had. It was human nature. Greed? Yes, but also fear of missing out. Career pressure, short-term thinking. If everyone around you is getting rich from real estate, if your neighbor just flipped a house for $100,000 in profit, if your boss expects you to keep returns high, saying this might be unsustainable isn't even a thought in the moment. Bubbles feel smart while they're inflating. They only look obvious in hindsight. And here's the uncomfortable truth. Most people weren't trying to gamble. They were trying to follow the rules, buy property, invest in safe assets, trust the ratings, trust the system. But they didn't understand how interconnected everything was. And that's the real lesson. The 2008 crisis teaches 3 powerful money principles. 1. Leverage magnifies everything. Debt can accelerate wealth, but it can also accelerate collapse. Before you use leverage, whether it's a mortgage, margin investing, or business debt, ask, if this drops 20%, do I survive? If the answer is no, it might not be a good idea. 2. Incentives drive behavior more than intelligence. Don't ask, are these people smart? Ask, how are they getting paid? If incentives reward short-term risk, long-term stability suffers. And that applies to Wall Street, it applies to corporations, it applies to your own life. Are your financial decisions built for short-term comfort or long-term strength? 3. Systems matter more than predictions. Almost nobody predicted the exact timing of the crash, but you didn't need perfect foresight to protect yourself. You needed margin, cash reserves, reasonable debt, diversification, income stability. The people who survived weren't the ones who guessed perfectly. They were the ones who built resilient systems, and that's the shift most people miss. Traditional advice focuses on returns. Wealthy thinkers focus on durability. Because if you can survive shocks, you can compound over decades. But if you blow up once, you're starting over. So when someone says the 2008 crisis was complicated, what they really mean is it involved complicated financial products. But the core idea, it's simple enough for a 10-year-old. People borrowed too much money to buy assets whose prices they assumed would only go up. Therefore, when prices fell, the promises collapsed. And here's the part that matters today. Bubbles will happen again. Maybe in housing, maybe in tech, maybe somewhere unexpected. But if you understand leverage, incentives, and systems, you don't need to predict the next crisis. You just need to build a life that can survive it. Because real wealth isn't about riding every boom. It's about staying in the game long enough to let compounding work for you. And the people who win long term, they aren't the ones chasing excitement. They're the ones building resilience quietly, while everyone else is celebrating easy money. That's the lesson behind 2008. If you found this helpful, sit with it. Think about where leverage exists in your life and ask yourself one honest question. If the tide went out tomorrow, would you still be standing? Thank you.